The Federal Reserve is set to meet once again this week in its ongoing fight to combat inflation. Many investors have dialed back on the recession expectations instead, thinking we'll hit a soft landing. And that's according to the Bank of America Global Fund Manager Survey that came out last week. Now, this has been helped by easing inflation, but still, they remain unsure about what the Fed's next step may be, with its 2% target still a little bit out of reach. Let's bring in now Global X Chief Investment Officer John Maier to give us his insights. And John, so you can paint with some broad strokes here as we get situated, but the Fed meeting in 2 days, decision in 2 days, it's a really big one. And what should we expect?
Well, I think it's pretty much a certainty that the Fed's going to raise by 25 basis points. There's about a 94% chance. So it's a foregone conclusion. The market knows it. So the question is, what are they going to say in their discussion when Powell speaks? And that's the real big point the market is looking for. We know that there are sticky points. Labor is sticky, housing is sticky, and the consumer is holding up the economy. So the question is, how much are they going to add to inflation? I do believe that the Fed is going to be a little more hawkish, but they might throw in some dovish lines because inflation has been coming down, but will it last?
Yeah, and it's really all about what Powell says when he takes to the podium and the lectern at about 2:30 on Wednesday, which we're going to cover live. Want to get to your notes here. Three key areas keeping the U.S. economy afloat: consumption, labor, and housing. And a lot of surprises here. A lot of surprises not only from the retail investing public, but also from corporate CEOs in their transcripts about how well the economy has held up in the face of all this Fed tightening. So consumption, labor, housing, how do these three interplay here?
Well, the consumer is really holding up the economy. So right now we know the cumulative savings rate is being depleted, but is still fairly high. We are seeing actually the savings rate tick up a little bit because people are concerned that they're running out of savings from the different pandemic programs because of the cumulative savings. But the consumer is still spending. We are in summer. People are excited to be out, and we are seeing labor strong in the service, particularly the service and leisure area. Now, what happens at the end of the summer when some of these summer jobs fall off? If you do look at some of the higher quality jobs, folks coming out of college, it's much more difficult to find even an interview. So there are some signs there that labor may be falling off, which is actually what the Fed wants.
And housing. Yeah,
and housing.
Big one.
Housing's a big one. There's not enough supply. We are seeing building stocks doing very well because there's just not enough supply. People are stuck in their 2.5% to 3% mortgage. They can't move.
Well, stuck. That's not a bad place to be if you're only paying that much. But if you want to move, sure, I totally get that. Want to move on to recession talk. The last time I believe the Fed had a soft landing or a no landing was 1995 after an aggressive hiking cycle in 1994, and not much else beyond that. Is it possible this time to escape recession?
Well, first of all, this recession or non-recession has been so telegraphed for the past almost 2 years at this point. I do think that the market is forward-looking. Recessions are the shortest part of a business cycle. If we do experience a small recession, the market is looking forward, from my opinion. You are looking at other areas in this narrow leadership that it's been driven by AI, and that is certainly helping the market. It's been a kind of a narrow leadership, but it is broadening out some, and you are seeing investments in private equity. And the AI story, from our perspective, is a real story.
What tickers do you like or themes do you like within AI? Because it's a pretty broad field.
Well, if you look at the earnings, this earnings season, you are still seeing that CapEx is very strong, 15% year-over-year gains, quarter-over-quarter, as well as last quarter was 14% quarter-over-quarter. So we've been in an earnings recession, but this CapEx cycle is very strong, which makes it a very unusual situation. The thing is, you have to drill down, it's efficiency. There's not enough labor, so companies have been underinvesting themselves for the past 10 years. You're seeing the CapEx cycle really strong because of that. Reshoring, friendly shoring related to the dynamics post-pandemic. So companies are all about efficiency. And that leads to robotics, and then AI is that new story.
Yeah, and it's finally great to see CapEx catching up after probably a decade and a half in hiding after the global financial crisis. John Maier, thank you for your insights here. Always great to have you around.